I'm sure everyone here has come across this problem where they enter into a trade and price reverses on them completely and goes in the opposing direction. And in this video, I will explain why that happens. So, let's begin. If you imagine this bullish candle over here. Here, you have a bottom wick, open, close, and then an upper wick. How do you think this candle was formed? This was the open of the candle. What does price do from here? It manipulates lower to create the bottom wick before expanding higher to the high of that candle. Then it has a minor retracement to create the upper wick of that candle. That is how that 4-hour candle was formed. There was a manipulation to create the bottom wick, and then there was an expansion to create the range from the low to the high before giving you a minor retracement at the end of the candle's lifespan to give you the upper wick. If you go down onto the 15-minute 9 AM candle, that was when the 4-hour candle opened. It had a manipulation to the downside. You see that manipulation? Below the candle's opening, that is your manipulation. And then you have an expansion higher. From 9:45 all the way until 12:30 PM, that was your expansion. Before, like I said, giving you a minor retracement to end the candle's lifespan with an upper wick. So that minor retracement simply came into this imbalance. And this is the important part. This is where the problem comes into play. Because you guys here, this is all hindsight, but imagine this scenario. The candle opens and then it has a bearish price action. This is where you guys think that it's going to continue lower and take out this low before eventually taking out this sell side liquidity. But based on what I just showed you with the manipulation, expansion, and then a minor retracement, the short you entered on was simply a manipulation to create the bottom wick before the candle showed you its true bullish expansion and price reversed on you completely. And since price is fractal, it's the same thing on every single candle. If you go into the hourly, if you look here on the hourly, price is clearly in a bullish sentiment. This counter raise are being respected. This imbalance here, before price expands higher, disrespecting pre-member raise. So what does that imply? The order flow is bullish. So any bearish price action should only be seen as a short-term retracement or a manipulation to sweep liquidity, such as this sell-side liquidity, to accumulate longs before distributing price higher to align with the bullish order flow. So, if we drop down onto the 5-minute, look at this. It gives you an extremely bearish movement lower. On a lower time frame, this was a very convincing bearish displacement. And many of you, when you see this bearish displacement, this is the way you would enter short here. But what do you think happens? Price then reverses completely, even though it had an extremely strong bearish confirmation on the lower time frame. The reason being, it's because your higher time frame dictates where your lower time frame is going to go. You are simply too glued to the lower time frame and you are unaware of what the higher time frame is currently telling you. That lower time frame bearish displacement was simply a manipulation before the candle expands bullish again to realign with the bullish direction. Like I said, we had these relatively equal lows here. So price came down, manipulated, took out this sell side liquidity to accumulate more longs before expanding higher and having a bullish closure because your higher time frame sentiment is bullish. So this bullish closure supports that sentiment. And where you entered in your shorts and got taken out, that was your manipulation of the candle. So that's the key lesson for today. Be able to identify where your manipulation is. Once you have identified that, wait for the confirmation, and where you would enter is during the expansion stage. So that's the main goal for this video. To help you with identifying the manipulation and where it's going to expand, you will always need a clear understanding of your higher time frame direction, and you will require patience. If we have a look at this example here, what has price given us? Higher time frame, daily. You have this buy side liquidity. The price has a strong rally higher, taking out this buy side liquidity, as well as low resistance liquidity resting below here, in the form of your trendline liquidity. Right, so what do you think happened here? Price swept buy side liquidity to accumulate shorts before distributing it lower. Confirmation on price distributing it lower, here. You have your market structure shift. And up close candles are supporting price to go lower. Here you have this bearish order block. So what could you expect for price to do next? The two functions in price, rebalance order inefficiencies, and then seek sell side liquidity. Here, you have your sell side liquidity, as well as this. But marking out your immediate sell side liquidity you have this current low. So let me reiterate. Price set buy side liquidity, give you a strong bearish displacement lower, taking out this swing low, giving you your market structure shift. So now it is confirmed that we are bearish, and we can see some sort of a minor retracement before continuing lower and taking out the sell side liquidity. So we play price up, price retraces back into that imbalance. Now we've jumped down into the hourly time frame. Look at what price shows us. It shows us very convincing signs that we are going bullish. But the thing is, on a daily, you know that this was simply just a temporary bullish push into one of these imbalances or this bearish order block before continuing lower, because your higher time frame being the daily dictates all of your trades. If the daily is bearish, any bullish price action on the lower time frame is simply a minor retracement or to sweep some form of buy side liquidity before continuing lower. Here, if you keep playing price out to the next candle's opening, which is the next daily candle's opening, at 5 PM New York time, marking out the open of this, what would you anticipate for price to do on the hourly time frame after your daily has tapped into the imbalances or higher time frame objective that is left behind? You would anticipate for the next candle to have a bearish reaction off of the mitigation of a premium array to continue the bearish higher time frame direction, internal to external. So, going back down, if we go back to the candle's opening of the next daily candle, anything above that opening line is your manipulation. Anything below that is where you would anticipate your expansion to be. Now, this is where a lot of you guys are messing up. Look how convincingly bullish this market structure is on the hourly time frame. At this point in time, a lot of you will look to go long here. Stop loss probably below there, take profit above here, and aim for this next draw on liquidity, being your buy side liquidity. The reason being is because you saw this large bullish market structure shift and it displaces heavily, so you don't want to miss out on the long position to take out this buy side liquidity. However, this is a very low probability trade. The reason being is because you are unaware of the daily time frame. The daily time frame is still bearish. It hasn't shown any sign to go bullish yet. So that's the first thing. The second thing is you're unaware of where price is manipulating to. Here, catching longs above this opening line is low probability, because if you're anticipating for the next daily candle to have a bearish expansion to react off of your higher time frame premium arrays in line with your higher time frame bearish direction, then anything above this opening line is simply your manipulation, and that is where most of you are entering in. You are entering at the manipulation of the candle, hence why it is called manipulation, because you are being tricked into thinking that that expansion is going in the direction of your manipulation. All that is happening there is those who are being manipulated are generating liquidity for when the true expansion move to happen to become counterparty liquidity for the expansion move. So here, if I remove this position tool, if we keep playing price up, let's see if it gives us that bearish market structure break to confirm that this was simply just a manipulation. And as you can see, that is exactly what you get there. Remember, the opening line. Price comes back, mitigates your daily bearish order block, and it gives you a market structure shift. A very strong market structure shift on the hourly time frame, which confirms that we are going to continue lower. And that is the bearish reaction we anticipated to see after mitigating into these premium arrays. This bearish market structure shift is much more high probability than this bullish market structure shift. The reason being is this bullish market structure shift was against your higher time frame bearish market structure, whereas this now aligns the hourly time frame with your daily time frame. So your highest probability trades will always come when your time frames are aligned. And this is also backed up by the stages in your candles formation. You had your manipulation above here, turning this from a buy program to a sell program. It's even more convincing because it happens above the opening line, which is what you would expect to create the upper wick of the daily candle if you was anticipating for that daily candle to have a bearish expansion. This manipulation above the opening line was to simply create the upper wick. So here, price displaces lower, taking out your market structure shift. This is where you could anticipate your expansion move to occur. Because you're anticipating that to occur, you could look for PD arrays to enter off of. Price could revisit this opening line and also revisit this bullish order block that turned into a premium array. Support to resistance. So this is where you could enter directly off of here, stop loss above there, and target the next swing low. That's option number one. Or you could drop down onto the even lower time frame and refine those entries in hopes for a better risk to reward ratio and a better stop loss placement. So let's do that. If I remove this, price taps into that key level, but it hasn't given us a bearish confirmation yet. So let's wait for that bearish confirmation. And as you can see, price retaps that key level sweeps this buy side liquidity, and this is why you always want to wait for your bearish confirmation, because if you was impatient and entered directly off of here, stop loss above there, it will run a bit into profit, but then eventually take you out. Hence why you always want to wait for your bearish confirmation. And as we get there, take out this low, that's your market structural break. You can look to enter here. Stop loss above there. Right, the reason for entering here is because you have this minor bearish displacement, old accumulation level to a new distribution level. And then what would you look to target? Again, you could look to target the same target that you was going to target if you entered off of the hourly, this next swing low. So see how it gave you a much better risk to reward ratio. Yeah, if you entered off of there, stop loss above there, you get 3R here. But here, you get an additional 1R. So let's drop down and see if it tags us in. And just like that, it hits your sell side liquidity. So do you see how simple it is? All you had to do was have a good understanding of where your higher time frame direction was going, identify your manipulation stage so you don't get faked out, and then take advantage of the expansion stage, because that is where the majority of your profit taking is going to happen. A lot of times, your manipulations will run higher. In some instances, this manipulation here can even run for this buy side liquidity to accumulate shorts before giving you that true bearish expansion. But question this, if you entered off of here, and let's say your stop loss was below there, look at our risk to reward ratio compared to this risk to reward ratio if you call the expansion move. Even if you successfully take profit at the manipulation stage, not only is this general move much lower probability compared to this expansion move, but it's also significantly less in terms of risk to reward ratio. And in the long run, the majority of your trades that you take at the manipulation won't always run for your take profit. So that's one thing to keep in mind. Now, this is your second example. Because price is fractal, what you just done now on the daily time frame all the way down to the 5 minute, you can do the same thing but using the 4 hour as your higher time frame, depending on what type of a trader you are. The main principle is identifying where your higher time frame direction is going and identifying where the manipulation happens. So here, on the 4 hour, what has price done here? Swept this outside liquidity and displays heavily past this swing high. If you zoom out, you can see that this was generally a bullish sentiment, backed up by the fact that you have these low resistance liquidity in form of your buy side liquidity or trendline liquidity. So that would be your overall draw on liquidity. Let's use this. What does price do here after giving you a strong bullish displacement, confirming that you are bullish on the higher time frame? Remember, my high time frame now is the 4 hour. It leaves behind this extremely large imbalance. Using your concept of internal to external range liquidity, takes out external, you would again anticipate internal before continuation to take out this overall draw on liquidity. So we'll play price out. Alright, this is London kill zone now. So let's drop down onto the lower time frame. If we mark out the next 4 hour candles opening, that would be at 6 AM New York time. So that is the next 4 hour candles opening. Remember, price is fractal, so the same concept applies. Anything below the candles opening is your manipulation. Anything above the candles opening would be your expansion. If you was anticipating for a bullish expansion, vice versa. If you was anticipating for a bearish expansion, anything above is manipulation, anything below is your expansion. Remember this 4 hour imbalance. What would you anticipate price to do here? After accumulating at this area, possibly take out the sell side liquidity, right? And tap into your 4 hour imbalance to rebalance all the inefficiencies before expansion higher and taking out your draw on liquidity, which aligns with your higher time frame bullish direction. So if that's the case, you want to wait for price to move into this 4 hour imbalance, give you that bullish confirmation so you could identify the manipulation stage and then play the expansion stage. So playing price out. Notice here that not every single candle is going to be perfect. What does price do? It still moves above the candle's opening. And price could very well do this. It could fluctuate between the above of the opening line and below the opening line. That's why context is so important. How is it fluctuating around this area? All it is doing is consolidating within this range. So when price consolidates, it just generates liquidity on both sides of the market. Even though price came down below this opening line and it gives you a strong bullish displacement, it could still come down again, take out the sell side liquidity before giving you that true expansion move. Right, so that's one thing to keep in mind. Identifying the manipulation isn't always going to be clear. And this is also backed up by the fact that we are yet to tap into a higher time frame PD array. Our higher time frame PD array is this 4-hour imbalance that price has yet to tap into. So, keep playing price out. Look what it does. Gives you an extremely strong displacement lower. So if we keep playing price out to when the 4-hour candle closes, which is at 10 AM, let's see what characteristics it shows us. And that is what you had. So this is an example of not every candle being perfect and playing towards your anticipation. Even though here, I outlined that at the start of this 4-hour candle, I wanted to see manipulation to tap into this imbalance before expansion higher and have the 4-hour ultimately have a bullish closure. But if you jump up onto the 4-hour, look what it does. It gives you a bearish closure but with a very long bottom wick. And a lot of times this happens. All this is simply doing for your next 4-hour candle to give you that anticipated bullish expansion because you didn't have it in the first candle. The first candle simply set up the stage for the second candle to have that bullish expansion. Because here, this 4-hour candle was to simply have a bearish mitigation and closure to rebalance this imbalance. It wasn't until the end of the candle's lifespan that it gave you that bullish confirmation. So here, you had this market structure break. And again, even though we anticipated for this 4-hour candle to have a strong bullish expansion, and it didn't do that, it still saved us from losses because we were anticipating for anything below the candle's opening line to be your manipulation. So you wouldn't enter off of these shorts. Right? Maybe you could have been lucky and taken some sort of profits here, but that is only one good trading opportunity presented. Because the next one, your stop loss would have to be up here. And price barely even runs for 1 hour. So it's not very high probability. If we play price out to the next 4-hour candle's opening, here, because the previous 4-hour candle had that long bottom wick with a bearish closure, that shows you that towards the end of that candle's lifespan, we had that bullish confirmation. And that is a positive reaction off of this 4-hour imbalance. So we could aim for this next drawn liquidity. And as that's the case, you would anticipate for this 4-hour candle to give you the anticipated bullish expansion that you didn't have with the previous candle. So again, anything below the opening line is your manipulation before expansion higher. You could look to enter off of this imbalance. If price comes back and reclaims it, stop loss there, take profit around there, and then go for that drawn liquidity for a nice 2R. Look what it does. At the start of that candle's lifespan, it was slightly consolidating, generating liquidity on both sides of the markets. Before this candle sweeps sell-side liquidity, so that's your miniature manipulation. It reclaims this imbalance and also taps into the trade. So here, this is your anticipated manipulation below the opening line, and you would expect for the next candles to expand higher and create your expansion phase for your 4-hour candle. So as you can see, that is exactly what it does. And it takes out your drawn liquidity. If we jump back onto the 4-hour, after we've swept out sell-side liquidity, we displace heavily past this market structure break, and then utilizing your concept of internal to external range liquidity, comes into imbalance, rebalances old inefficiencies, and taking out external range liquidity. This is your next drawn liquidity. We identified a manipulation below the candle's opening. So remember when I drew out the candle's opening, we entered on the bottom wick of that 4-hour candle, and then we took the majority of our profit at the expansion stage, which is where you had your candle's body. So that concludes this video. To sum it up, imagine this is your bullish candle. Your ideal entries will be at the bottom wick, and you will catch the expansion. Vice versa, if this was a bearish candle, your ideal entries would be at an upper wick, and you would catch the expansion. Because on a bullish candle, anything below the opening is your manipulation, and for a bearish candle, anything above your opening is your manipulation. So that's the first thing you want to identify. You want to identify where the manipulation happens and then enter on the expansion. And what helps with identifying where your manipulation is going to happen and where your expansion is going to happen is a solid understanding of where your higher time frame direction is heading for and what key higher time frame levels are we currently in. So I hope you guys found this video helpful. If you did, please like and subscribe. If you have any questions or suggestions for future videos, please leave them below in the comments. Like always, take care, and I'll see you guys in the next one.